Would you like to invest in a company that's been growing earnings at a rate of 27% for the past 10 years? They've also been growing dividends for the past 17 consecutive years. And they recently announced a 9.7% dividend increase as early as February. Welcome investors to Fiscal Voyage. I'm Felix. This video was suggested by James. James watched a previous video of mine and he wrote in a comment that he would like me to do a stock analysis on Robert Half International. So thank you, James, for watching and commenting. And you could also leave a comment what company you would like to see next in a stock analysis in another video. If this is your first time visiting the channel, make sure to subscribe because I like to do these type of stock analysis video where I provide fair value prices and my recommendation if it's either buy, hold, or sell. So we're going to do a stock analysis on Robert Half International. Thank you, James, again. Okay, here's a stock analysis on Robert Half International Inc. Ticker symbol RHI. The company is also referred to as Robert Half. It's a global human resource consulting firm. It is a member of the S&P 500 and is credited as being the world's first largest accounting and finance staffing firm. With over 345 locations worldwide, the company operates through three segments: temporary consulting staffing, permanent placing staffing, and risk consulting and internal audit services. If we look at the fundamentals, revenue grew at a compound rate of 7.5% from 2010 to 2019, which is a decent rate, a nice rate of revenue growth there. Net income at a whopping rate of 23.9%, so that's outstanding. So they're decreasing costs with that revenue growth and that net income, so that's great there. S&P doesn't have a credit rating. Operating income came in at 20.5% compound annually for that 10-year period, which is also outstanding. However, the company has slowed down over the past 5 years, where revenue for the past 5-year average at 4.49% and net income by only 6.12%. So that 20% growth for net income for the past 10 years has decreased now to 6%. Earnings, however, in this 10-year period is a whopping almost 30%, which is outstanding. You hardly find companies growing earnings at almost 30%. However, that is slowed down again as well. For the past 5 year, earnings has a 5-year average of 9.73. If we continue with the fundamentals, 2019 the company earned $3.90. Net margin came in at 7.5%, which net margin has been consistent, so this is a very consistent company. Net margin for the past 5 years been around 7.5%, so that's consistent, so that's good there. Return on equity is pretty high here at 41.2%, so that's real good. Current dividend yield is a nice 2.64. It's not the 3% I like to look for or higher, but a 2.64 is real good because the company has a 5-year growth rate of 11.5, which is great. That gives us a charter rule of 14.14. So that's a great score there for the charter rule, where we like to see it at 11, 12, and higher. So that's good. So that dividend growth makes up for that low dividend yield. And the company has a pretty safe dividend at only 75.4%. Which is for 2020 expected earnings. We'll see that in a few slides here. And they've been growing dividends for 17 consecutive years. And the best part is they actually increased the dividend in February by 9.7%, which is outstanding. And something to consider here also, the company 5-year dividend yield average is only 1.9%, where the current yield is 2.64. So that's a good indicator there of the valuation, that the company may be undervalued, but watch towards the end and we'll determine that. If we look at the balance sheet now, debt to cap is very low here at 14%. Current ratio at 1.73, which is pretty good. Is above average. Average is about 1.5. We got here 1.73, so that's real good there. You like to see it at 1.5 or higher, so that's good. Debt to equity is very low here, actually, at 0.18. I'm okay with companies at 1.2, 1.1, and 1.3 in that area, but this is a 0.18, so that's great debt to equity ratio here. However, the price to book ratio is pretty high. 5.22. I like to see company in the twos, price to book ratio 1.52, and maybe even lower than 1.5. But it is lower than the 5-year average, which is 6.09, so that's a plus there. So if we look at analysts' expectations for their future outlook, 2020 is expected to earn $2.60. This is, however, much lower than the 2019 earning of $3.90. Of course, the pandemic and basically a hire freeze, because Robert Half makes some money with getting people employed. Employers use them to filter through employees and whatnot. So that's why the earnings are expected to be lower than 2019. However, 2021 is expected to pick right back up at $3.10. Most analysts are expecting for the next 3 years annual growth of 2.5% in earnings. And putting down my dividend yield return model, I get a projected return of only 7.4, which is not something I like to see here. I like to see 9%, 8 maybe, 9% or more. But we got it here at 7.4%. And currently the company has a PE of 15.3. This is based on the $3.90 for 2019. But if we base current price to expected earnings of $2.60 for this year, we get a PE of 19. This is, however, higher than the 5-year average, but because 2021 they're expected to earn more, this should bring it down pretty significant. So we look at the fast graph here. Again, the black line is the monthly closing price. The orange is the earnings multiple of 15, and the blue line is a normal PE ratio of 19.5. As you see here, from 2019 to this year is expected to drop 33% the earnings, from 390 to 260. And as you can see from the early of the year, of course, with the coronavirus pandemic, the price dropped significantly, matching more or less 2015 prices. So analysts has been pretty right in predicting the earnings expectations. So if the company goes to its normal PE of 19 or 20-ish, you could get some pretty nice return of 22% for the next 2 years, or annual return of 13.5. So that's real good. But these are all expectations, analysts. So a lot of things could change. But the one thing that I want you to see here is that from 2015 in like mid-August, September area, the price dropped to around $35. Same thing with the pandemic. It's got low as around $35. I think it'll be very attractive around $40, $45, because as you can see, the dividend adjusted earning yield is only 6.55%. So I like to see it 7%, 8% or higher. Again, you see the 14% low debt to cap ratio, so that's great. So if we look at the fair value price, CFRA has a fair value of $60.34, Morningstar at 51, FastGraph at 44, and Yahoo gives it at $50.77, and my dividend discount model analysis at $51. I use 8% for the next 3 years and 7% after that with a discount rate of 10%. To get my dividend discount model analysis of $51. Averaging out the 5, we get a fair price of $51.50. Currently, the company goes for $50.77, which means it's undervalued by only 1.4%. That does not meet my criteria of 10% or more, and especially I don't mind paying if the company is undervalued by 5%, but it has to be extremely high quality company where earnings is more predictable. This company has a lot of earnings, highs and lows or whatnot, but that's why I have give it a recommendation as a hold. So I have a hold recommendation for Robert Half International because the fair price and the current price is right in a line. It's only, like you saw, 1% less currently. I like to give myself a 10% margin or more when I do these fair price evaluation. Now, that doesn't mean that the stock could go up 10, 15%, 20% from now, you know, but I like to give myself a margin of safety when I do these estimates. So that's why I give it a whole recommendation. The company itself is great. The balance sheet is real good, it's strong. I like the debt to equity ratio of 0.18. Normally I look at companies and I see, you know, 1.2, 1.3 ratio. The current ratio of 1.73, which is the total asset divided by total liability, is still good as well. It's not great, but it's above average. It's at 1.7. Average is about 1.5, or that's what you would like to see it at. And the dividend yield is decent. I love the consecutive years of increases and the most recent dividend increase. So fundamentally, the company is real good. I like it. I just don't like the price right now. So that's why I have a whole recommendation. So thank you for watching. Again, make sure to subscribe and like the channel to support the channel and help me grow this channel. So thanks again, and leave a comment suggesting what video would you like to see next, like what company would you like me to do next, and give me the name of the company and the ticker symbol. So thanks and have a great one.